welcome to Business Television India. I'm Abhishek Ranjan and you're watching Financial Planner. Joining me on the show is Feroze Azeez of Anand, Rathi Private Wealth Management. Today on the show, we discuss certain key provisions of the Income Tax Act and how a better understanding of these provisions can help you in tax planning. To begin with, majority depends highly on CAs and advisors for tax planning. Is this over-dependence on CAs required, especially when tax planning ideally is a continuous activity rather than a one-time plan?
Abhishek, I think it's important to understand that in an investing life, you should try and be on the driver's seat when it comes to taxation. Taxation is a very, very important item, and you trying to delegate it completely might not be a great strategy, especially when you're going to be investing for 10, 15, 20, 30 years. You being on top of it and being on the driver's seat with assistance from advisors and chartered accountants is a better strategy. That's what I'm recommending. For you to do that, I don't think it's such a complex problem to solve. If you actually narrow down on what are the important sections which you need to know from investment standpoint, and if you could identify those 5-7 sections and the subsections, and if you understood them clearly, I don't see a reason why somebody could actually not adopt a more proactive kind of a strategy when it comes to investment taxation.
Before we get on to understanding the provisions of the Income Tax Act, Feroze, if you could help us segregate the various income heads that one must broadly take into account to ensure you do not fall in the wrong side of tax laws, and most importantly, you end up planning your taxes efficiently.
Yes, I think quite a few of us don't end up remembering the 5 heads under which you can have income. So if I named them for a person to remember, one of them is income from house property, which is generally rental income. Second is salary. Profit or gains from business or profession is the third head. Capital gains head, and the last one is income from other sources. So these are the 5 heads which a person should remember all the time, and that's when I think that's a good beginning if you remember these 5 heads to start with, in fact.
To begin with the key provisions, if you could help us understand what section 70 to 74 of the IT Act entails, and also help our viewers understand what are the different losses that one can potentially set off.
See, before I get into that section, it's important to know that if you remember the 9 sections which we are going to discuss today, or 9 broad heads, I think it covers 80% or 90% of the required tax from an investment standpoint. Not running a business could have a little more complex taxation, but when it comes to investment tax, these are the 9 most important things which one should remember. And that rightly, Abhishek, like you said, section 70 to 74 becomes one of the most important group of sections from an investment standpoint. So what does it actually say? It first 70 to 74 says, item number 1, is that if you have a loss on house property, you can set off up to 2 lakhs against any head, not just gain from house property. So what I mean by that is, if you have a loss from house property, you can use the loss and set it off against all the other 4 heads which we just mentioned. So it's one of the strongest losses which cuts through all the different heads and is set offable. But the unfortunate part is, a few years back there was an upper limit put to this, and it was capped at 2 lakh rupees. Earlier it was uncapped. That was quite an arbitrage and extra tax benefit which most of us used to have, and now that is capped at 2 lakhs. The next question which pops up in one's mind is, how do you make losses in house property? Let's assume you have a house where you're paying an interest of 10 lakh rupees a year on the 1 crore rupee house which you have borrowed on. If you have paid an interest of 10 lakhs, you got a rent of 5 lakhs. So your loss is 5 lakhs because you're paying more interest than the rent you received. So this 5 lakhs can be categorized as a loss on house property, and it has the power to be set off under all the other 4 heads up to 2 lakhs in a financial year. And you can carry forward the residual 3 lakhs which we just mentioned in the illustration for the subsequent 8 years. So it's important to understand this first thing when it comes to 70. And then comes the next one in this bracket of 70 to 74. If you have made business losses, you can set off business losses against every other head other than salary. So business losses are the second most powerful losses because they have the potential of going across heads and they are set offable. And if you have something excess in this category, you can carry it forward again for 8 years. Except salary, you can use business losses to set off against all the other 3 heads other than salary, and you can of course set it off against business gains as well. So the next one is capital gain, third item in this bracket of 70 to 74. It says that you can use short-term capital gains and set it off against any short-term capital loss. On the other hand, any short-term capital loss can set off short-term capital gain, one. It can set off long-term capital gain from any asset under the same head. So that's the next one. And the last one, if you have long-term capital losses from any assets, then you can only set it off against long-term. So these are the most important tax provisions which you have to use when you look at a portfolio, to my mind.
Take us to the provision pertaining to the capital gains from residential house, and how have things changed with the announcement of rollover a capital gain being extended to investment in 2 residential houses in the interim budget?
Yes, I think property is one of our favorite asset classes as Indians, and that's why the research says 60% of high net worth individuals' surplus money is invested in real estate. So understanding section 54, 54F, 54EC is an integral part, or we are duty bound as Indians to understand this taxation, Abhishek. So if you went to more specifics of section 54, it says that if you have bought a house, for example, at 1 crore rupee long back, and you've sold it after years at 3 crore rupees, you've made 2 crore rupee gain on a 1 crore rupee base. So let's assume that 1 crore rupee base is already indexed. That's another topic actually. But if you have made 2 crore rupees of capital gain in a property, since it is long term, you can end up paying the tax at the rate of 20% plus cess and surcharge, or you can take this 2 crore rupees, which is only the gain amount, not the entire 3 crores, only the gain amount, and reinvest it back in a residential property. Then you don't have to pay tax on this 2 crores, which could have worked out to anywhere between 42 to 44 lakhs. You can save this 44 lakhs of tax by reinvesting the gain amount only back in a residential property. This was the rule earlier. Now the rule changes to, you can buy 2 houses and put this 2 crores, for example, as 1 crore and 1 crore, 2 separate houses. So this is the latest change in the interim budget. If you have sold a house and your family has expanded and you have 2 children, you end up buying 2 houses for 1 crore each out of your capital gain amount. You will now have it exempt. Earlier the mandate was only one of these houses could have got you the tax exemption. Now both these houses, if you so chose to buy, gives you an exemption.
Moving on, help us defog indexation on long-term capital assets as laid out in section 48 of the IT Act, and also, most importantly, how does this benefit us?
I think indexation is a very, very important item. And like you rightly pointed out, Abhishek, section 48 is what speaks of indexation. Firstly, it's important to understand what is indexation. And secondly, where all is it applicable? How does it benefit me as an investor? Largely are the 3 important questions of this category which we need to be answering. So let's start with what is indexation. Indexation is nothing but a tax exemption you getting on the inflation which has occurred during your period of investment. Let's assume you had put 100 rupees in a debt fund. Okay, after 3 years, if it has become 130 rupees, 30 rupees is your gain. The income tax department says that you don't have to pay tax on the entire 30 rupees because the value of 100 rupees has deteriorated because we are a high inflationary economy. That much more important for us to understand indexation. if the indexation, which is the inflation number which gets published every year, actually should have brought you to 120, but you are at 130, optically you have made 30 rupees, but indexation or inflation, it's a synonym or something very similar, has destroyed 20% of your value in 3 years in the form of purchasing power. So you have to pay tax only on the differential of 10 rupees. This exemption of 20 rupees on account of the value of money deteriorating with time due to inflation, that provision is called indexation. So you save yourself a tax liability to the extent of inflation in the form of an index which gets released every year, is called indexation, point 1. Point 2, indexation is applicable to most assets except 2 largely which form one's portfolio. One is equity, it does not come into indexation, and the other one which does not have indexation is bonds and debentures. Quite a few people, without being ignorant that bonds and debentures can't be indexed, they end up actually taking indexation even on bonds and debentures. So equity mutual funds, equity stocks, even after they become long term, there's no indexation benefit, which was actually introduced in 2018. Long term capital gain was reintroduced, but indexation was not given as a provision for equity, and it is also not something which you should use for bonds and debentures, which most of us as Indians, again, we love debt instruments, so we end up owning it. By mistake, you sometimes take indexation, which is a wrong method of computation, and you're actually being on the wrong side of the law.
Now, continuing with the topic of indexation, Feroze, there was a change in the base year from 1981 to 2001. Now, what sort of an implication will this tweak have?
Yes, Abhishek, it has had a very, very important change. The base year indexation, base year moved from 1981 to 2001. It looks like a small change, but this can actually change the tax liability on most properties which we own ancestrally, or properties which you bought yourself much before 2001. So what I mean to say is that earlier your indexation was a number which started from 1981 and moved forward. Now it is from 2001 and it moves forward. So let's assume that you had a 1 crore rupee house bought in 1981. And if you were fortunate to get the real estate rally back then, and that is worth 30 crores today, and this is some example which I know of a person who has had exactly the situation in Mumbai, bought a house for 1 crore back then in 1980s, and then it is today worth 30 crores. The taxation, as per indexation, the 1 crores indexed value was 12 crore 15 lakhs. 12 crore 15 lakhs. So the taxable amount was the differential between 30 crores and 12.15 crores, which is 17.85 crores, taxed at the rate of 23.92, and the tax liability was 4 crores 27 lakhs. That was the tax liability before the index year changed from 81 to 2001. Then after the years change, what does one need to do is find out the valuation of the property back in 2001 from a government approved valuer, and the value turned out to be 15 crores. So the value of that 15 crores becomes the beginning point, and when you look at the indexed value of 15 crores today is greater than the sale value, so 30 crores. So the tax liability turned out to become 0 in this case, because the value of the property in 2001 was somewhere close to 15 crores. So indexation year change is a very large important change which every one of us should keep note of and calculate the tax impact on all the property you own which was bought before 2001, and I think some people have got a very, very pleasant surprise when they have done that specific math to properties which they have held before 2001. I think for the sake of curiosity, curiosity is the only thing we can create on a show like this, but it will take you a pen, paper, and some degree of weekend mathematics you'll have to do to find out the precise benefit of this provision change in your life and your asset value post-tax.
This brings me to a very interesting aspect that many of us would not even be aware of, that gifts are taxed too. It will therefore be interesting to understand the intricacies around this from you.
Yes, I think it's important to understand that gifts in India are partially tax-free, not completely tax-free, depending on who is the person who's gifting it to you. Of course, you're happy that you're getting a gift, but it's important to understand whether that gift which you are getting, is it taxable or not taxable. The section which speaks largely about gifts is section 56. It says that if a person who's a non-relative of yours gives you a gift up to 50,000, it is tax-free in a financial year. If you supersede that amount, the entire amount is taxable. If you've got 51,000, it is not just the 1,000 which is taxable, the entire 50,000 plus the 1,000, 51,000 is taxable. That's point one. Point two, between relatives, the gift amount is unlimited. You can gift to a relative any amount of money and not pay tax. The recipient does not pay any tax as long as he or she, the person who's gifting it to me as a recipient, is a relative. That leaves us with an obvious chronological next question. Who are defined as relatives? Let me read it out to you. Spouse of the individual, brother or sister of the individual, brother or sister of the spouse, all lineage, ascendants and descendants of an individual, vertically upwards or downwards, all lineage, ascendants and descendants of your spouse are also called relatives. Brother or sister of either of the parents of the individual, like we call it in the Mosi, Mosa, Tau, all these people are relatives as per income tax, and spouse of the person referred above. All these people and their spouses are all relatives. So it's a very broad definition of relatives. If you receive gifts from any of these people, then it is tax-free and the amount is unlimited. If it is a non-relative, not mentioned in the list which I just read out, then the maximum limit is 50,000 rupees, beyond which you are taxed for the entire amount. Barring one or two exceptions, which is called marriage and if you have received a gift through a will. So these two are tax free. So if I am getting married and if I receive gifts from non-relatives for a total amount of, let's assume 2 crore rupees if I am lucky, then all of it is tax free. And if you have received something through a will of a person and at the demise of the person, the executor of the will executes the will and transmits that wealth or the gift to you, then that is also tax free. So these are the two exceptions when you don't have to be worried whether it's coming from a relative or a non-relative.
Now Feroze, also if you could help us explain what is a speculative transaction and also what qualifies to be a speculative transaction. If you could help us put things into perspective.
So the basic principle on which speculative transactions are categorized are those transactions where there's no delivery of the asset. For example, you're trading in something but never taking the delivery of that commodity, and before the delivery reaches you, you are swapping the trade from a buy to a sell. So what do you mean by that is not taking delivery of a specific transaction or the commodity on which you're doing the transaction is generally categorized as a speculative transaction. Even a race course transaction where you're not being delivered anything, you're just betting, is called speculative income, to give an illustration. Actually, derivative transactions are also something which don't give you a delivery in India. India is non-delivery based derivatives on equity. If that is the case, then derivatives should ideally be classified as speculative, but there was an exception given to derivatives, especially equity derivatives, and now in the recent past even commodity derivatives were given an exemption and said that those will not be categorized as speculative in spite of being something which is non-delivery. So derivatives don't classify as speculative because there was an amendment, if I remember the year right, it was 2007, section 43(5) was introduced. And so speculative transactions don't have delivery, but still derivatives are categorized as not speculative because there was an amendment and there was a subsection 43(5) which was given. It's important for you to identify speculative transactions because doing an intraday trading without taking delivery of the stock can also be construed to be speculative, and speculative losses cannot be offset against anything else but speculative gains, and it can be only carried forward for 4 years, unlike the rest of them which are carried forward for 8 years. So identify them. Make sure when you're doing your transaction you're clear that this is not speculative, and before you enter the transaction you should understand the nature of the behavior of that transaction to ensure that you are safe and you're not getting into something which you didn't understand before you got it in your portfolio.
At the outset, we brought out the point around how crucial is it to not find yourself on the wrong side of tax laws. And there is a provision in the IT Act which draws a line between tax planning and tax avoidance. In this context, let me ask you to explain to our viewers the general anti-avoidance rules and what does this provision entail?
See, we can just give indications. There are several interpretations to it, but GAAR, as they call it, they abbreviate it as General GAAR, General Anti-Avoidance Rules, actually states in principle that any transaction you get into which does not have a commercial benefit or a possible loss and is only undertaken specifically to bring down your tax liability and there is no other commercial purpose to it, would be categorized as a transaction which can be disregarded by the assessing officer during your return filing and subsequent assessments. So general anti-avoidance rule says that if you take a transaction which has no other commercial interest but only tries to bring down your tax liability is called tax avoidance, not tax planning. So that's what GAAR says. As the principle again goes on to say that this is invoked in cases where the SSE has tried to save tax of greater than 3 crores, which is a very large amount. For most of us, it might not be applicable, but these are only directional or principal matters. Of course, the income tax department is the best judge of its implementation. We can just have some degree of interpretation which might be right or wrong, but this is something which you need to be aware of, and doing transactions which are only specifically meant to bring down your tax liability is certainly not a good idea, irrespective of the size of the tax avoidance or planning so-called planning which you are intending to do. So doing transactions and the byproduct can be tax benefit or a tax reduction, tax liability reduction. It can't be the prime requisite of a transaction itself.
Thank you, Feroze, for your time. It was indeed very helpful to understand from you the various provisions of the Income Tax Act which will help guide our viewers to a large extent on minimizing or setting off their taxes arising out of the broader income heads that we discussed on the show. That's it for this edition of Financial Planner. Stay tuned to BTVI for more news and updates on the other side. Thanks for watching.